There's a major flaw in the way our banking system is run. You think that when you go to the bank, you're putting your money in to the bank, either through a direct deposit or you go to an ATM machine, you go to the teller, and you expect your money to be there because you put it there. You think it's in there and it's safe in the bank. And the bank actually contributes to this fiction because, not so much anymore, but in the old days, the bank was made out of, there'd be like this granite edifice, and you'd walk in and there'd be these huge barrel vaulted ceilings when you walked in, and then there'd be tellers behind a iron grated apparatus that would give you the sense that everything was safe. And then if you looked at the corner of the bank, there'd be a huge vault, like 20 feet thick, and there'd be this elaborate steering wheel on the bank vault, and it was just open just imperceptibly, and you could look sort of around, and you could see what looked like money or gold or something valuable inside. And of course, it was all a fiction. It's all an act. Because if your money were really there inside the bank, then the bank wouldn't be able to make any money. Because how does the bank make money? It makes money by taking your money and lending it out to all sorts of other people in the form of mortgages, in the form of home equity loans, in the form of corporate loans, in the form of municipal loans. They use it to underwrite, they use it to trade. They use your money to make money. It's an incredible business, actually. They use your money to make money. And what do they pay you for your money? Well, as all of you know who look at your savings interest rates, your checking account interest rates, it's about as close to zero as it could possibly be. And it's sometime in Europe, it's less than zero. So we're fortunate that it's slightly above zero, but basically it's zero. So they take our money, which they pay us nothing for, and then they lend it out for a very widespread, depends on the credit, of course, but 10, 8, 9, 10, 11%. So they're paying nothing for our money, and then they're lending it out at, say, 10% interest. So that is a really good business, and it's backstopped by the federal government, the Fed. It's backstopped by the FDIC. It's backstopped. People's accounts are backstopped up to $250,000 by the FDIC. If you have a brokerage account, it's also has insurance related to it. So I don't think you can find one other business on the face of the earth that does not have to pay for its raw material. Banks don't have to pay for their raw material. They get it for free. Their raw material is the money that we deposit in the banks. When GM makes a car, they have to pay for plastic, glass, steel, aluminum, rubber, electronics, labor, whatever it is, they have to pay for. Banks, for their raw material, they get it for free. So then they lend that money out in the form of these corporate loans or all these other things that I talked about. And the system works great until everybody wants their money back at the same time. And then they all go to the bank because they're really panicked. There's something that's set off a panic. And they go to the bank and they discover that they can't get their money because what they don't realize is that their money was never there. And so they can't get something that was never there because it was being lent out. So that's what happened in basically every other financial crisis until the one in 2008. People went to the bank because something set them off. Another bank failed, land prices got too high, people couldn't pay their mortgages, whatever it was. They wanted their money, they all went to the bank at the same time, the money wasn't there, they freaked out, banks closed because people wanted their money, they didn't have it, they were not in business anymore, so-called run on the bank. In the 1929 and 1930s, there was huge long lines of people waiting to get their money at the bank, but they were never going to be able to get their money at the bank because their money wasn't there, and it was never there. And that's the fallacy of our banking system. It's called fractional banking, which basically means that you don't have to keep the money at the bank to be a bank. So we condone that, and it usually works beautifully until it doesn't.